Alright, new video. Let's jump right into it. And this time, we're going to make sure we actually switch to the screens we're talking about. Let's get into it. Question 1. TikTok warning, my current strategy. So the TikTok warning I'm talking about is just be careful of accounts on TikTok that are going to try to tell you that they can predict what stock prices are going to do. I'm talking about people that are like, buy this stock tomorrow. This stock's going to the moon. They are full of crap. It's impossible to do that. People think that's what day trading is about. That's not what it's about. That's not even what any stock market strategy is about. Nobody can predict what a stock is going to do short term. You can predict what a stock will do long term, but you cannot predict what a stock will do short term. So it's just disingenuous to be like, this is going to buy this tomorrow, because you have no idea. I've said this before, but I've seen stocks post amazing earnings and price drop. I've seen stocks post crappy earnings, stock price go up. Good news, bad news, it's impossible to tell which way a stock's going to move. So just be careful of those accounts. And then my current strategy. So let's go to Thinkorswim. My current strategy is pretty simple. I look for stocks that come up on my scanner. I've showed you all this scanner before. Let's go back to it. It is this scanner. Boiler Room Trading posts this every day, every trading day on their YouTube channel. It's live. It'll look like this. Just make sure that it's live down here. Here. Well, no, it'll be right here. Right now it's not live, sorry. The live one, it'll say live down here. And then look for these stocks that pop up red. They say bottom bounce. It means that the stock is trending towards a bottom bounce. Its relative strength index is low, and it's either past its first or second deviation. What I mean by that is here. Let me get back into TD Ameritrade. This stock XPO that I traded this last week, that came up on the scanner because it fell below one deviation under its mean. Mean meaning its average. If you don't know what a standard deviation is, go Google it. It's a pretty common statistical term, but essentially the further you get away from the mean, the higher probability it'll come back to its average. So this middle line here is constantly changing. Like the average price of a stock is constantly changing over time, and these adjust with it. So here it was 2 standard deviations under its average, which is a good indicator for a correction towards its mean, a bullish move towards its mean. And I'll maybe do some videos on these in the future, but research MACD, relative strength index, all these indicators are things that I use to make my decision, because every stock that comes up on that scanner I showed you, I don't buy. The things that I look for are what caused the drop, the overall valuation of the company, what do I feel about it, and I also use these studies such as MACD and relative strength index to make my decision if I'm going to buy the stock or not. XPO couldn't have been perfect. Every single metric, every single study told me to buy, so I did. And it's one of my best trades of the year so far. It was like a quick, smooth, easy, I think $1,000 or something close to it. So let's talk about what's happening here. So there's 2 things that drive stock price. There's one, fundamentals, which are things like revenue, earnings per share, fundamentals. Those cause a slower increase or decrease in stock price. They're not as, they'll cause a more gradual increase or decrease. News hype is what will cause these big up and downs in stock price. And so I'm looking for big dips in stock price, and then I'm looking for news to, 1, explain to me what's going on, and 2, sort of give me some confidence that it isn't justified. And that's sort of what I do. I look for these stocks that drop like this, and I buy them under their first or second deviation, and I ride them back to the top. Not to the top, to its mean, its average. And it really depends on how confident I am in the stock for how long of a ride I'll take on it. Not every trade or every one of these stories is going to be as perfect as XPO. I've seen stock takes these huge dips and have a little rise, and then sort of keep falling. I've seen stocks just like XPO, they take this huge dip and come back up to nearly its all-time high. It really is, you have to take your time, practice understanding what's going on to make sound decisions on how you should handle the situation. So XPO, let's actually dive in and explain what's going on here, because this happens all the time. Well, I was in Paint here. Hello. Ooh, my computer is sort of screwing up. Is it really struggling to open Microsoft Paint? Okay, here we go. Paint. So let's take a basic chart. We got price on the left side, time on the bottom. Let's make up a basic stock, ABC. Oh goodness, we want Paint. Come back. Just basic, made up stock we just came up with. So, see if I can get a pencil here. We know that stock prices move, upwards, sort of sideways or down, long term and short term. But we know that they don't move like this. They don't move in straight lines ever. The more stock moves like this, the more volatile it is. The flatter it is, the less volatile it is. Your day trading, you really want to deal with stocks that are more volatile, not less volatile. What in the world? Go back to Paint. Why is it doing that to me? Oh my goodness. Oh, I must have set a... That is not good. Okay. Anyways, let's focus on this. Just give me the eraser. I'm just going to start using the eraser instead. So we just know stocks move like that. They don't move in straight lines, and that's because there's two factors influencing stock price. There's news and there's fundamentals, but really what it comes down to is volume on the stock. So there's buyers that are bullish that are pushing the stock price up, buying more of the stock. There's bears who are selling the stock, pushing the stock price down. And so that's when you see these fluctuations. As a day trader, I'm looking to ride these momentum swings in the stock. And so the story I'm telling that happens every day, what I'm about to show you, and this is like, I'd say 80 to 90% of my trades, this is exactly what happens. We got stock ABC. Let's say that it's oh gosh, give me a drawing. Not that. It's a well-performing stock. So it looks like this, we got some stuff going on here, and then right here, something happens. Let's get another colored line here. Let's draw this. And we're going to say that this is the after hours session. So trading time, we'll say this is Monday. And we'll say this is Tuesday. And this is between Monday and Tuesday, the hours that the stock market is not open. You can actually see that in Thinkorswim right here. This little lighter shade area. This is after hours trading. Let's go back to Paint. So, well, actually, let's go back to Thinkorswim. So you see here, something happened here. XPO released what's called their earnings. So all companies that are trading must release what's called earnings, and it's just reporting what their earnings per share were and their revenue. There's more to it than what I'm saying, but that's like a basic summary of what's going on. And so look what happened here. XPO released their earnings, and if you actually go take the time to look at the news, they beat earnings. So, they were estimating the earnings that would hit, and they were estimating the revenue that would hit, and they beat them both in their financial statements, which caused this big increase in their price overnight while the stock market was closed. And so this happens. Let's go back to our pretend stock here, ABC. So let's say they release earnings. And give me blue again. Hello, can I go back to this? And it shoots up in price to about here. And then the market opens. Everyone begins trading. And we see this big dip. Now you're probably wondering, like, why is this dip happening? Well, if they release earnings and they beat earnings, you would think that the public would view the stock as bullish, that it's doing well, that you should invest in it. So why is their stock price dropping? The reason is because investors are seeing an opportunity to get out. They're saying, we bought XPO sometime in the past. They just went up 10, 20, 15% overnight. Let's mitigate risk, sell, and close our position and take our profits and move on to our next trade. And so you're seeing this huge sell-off. Now, there's a difference between a sell-off that's justified and a sell-off that's not justified. Justified is not the right word. A sell-off, like if a company gets caught doing sketchy stuff and they're in an investigation for fraud, don't deal with that stock. If you see a company that drops huge and they beat earnings, something's fishy, right? Like that's called an opportunity for you. So I come in and I buy. I wait for the trend to start trending up. I use things like if you look here, I was looking at relative strength index and MACD, and I was waiting for sort of the momentum to shift from the downside to the upside. When I felt that the momentum was changing, I bought in right about here, and I wrote it up. And one thing to be very careful of when you're doing this strategy is that I can almost without certainty guarantee you that when these huge dips happen, that there will be a correction. But there's no way to know how much of a correction that will be. So, I tend to mitigate risk by taking short rides on these stocks. If I feel really good about them, I might take a long ride. XPO, felt very good about it, so I actually wrote it on this, saw it dipped again, bought it again, did a couple trades on XPO, because I felt pretty good about it. But don't get cocky and think that just because a stock takes this huge dip, that it's going to come all the way back up to where it was. It typically doesn't do that. It does correct a bit, and just take advantage of the fact that you can predict movement directionally, but not how long that movement will be. And that's essentially my strategy. That's what I do. I've explained this before, so I hope that it makes sense. Let's go on to the next question. Wow, I talked about that for a long time. What I plan to change. So my strategy is what I just showed you. It's the same thing over and over again. I'm looking for stocks that are taking these big dips caused by earnings releases or big news releases, something. And I am somewhat predicting with studies their directional change, and I'm just sort of watching them in real time to see when the momentum swings, and I'm riding that momentum. What I plan to change is there are also these opportunities to do the inverse, which is stock prices will sometimes in the market dramatically go up, and then they will come crashing back down. Let me see if I can find an example of a stock that's done that. I know BSQR does this all the time. Yeah, right here. Let's take a look at that. So BSQR is a stock that I'm somewhat familiar with that has done what's called a squeeze before. So this is the way I want to change my strategy is not only do these bullish strategies, but also do these bearish strategies where I'm actually shorting the stock. I just don't have the comfort level yet to do it, but I'm learning more and more on how these work. So if you understand what happened with GameStop, you can actually understand what happens with a lot of these small stocks, is that you have companies that short the stock, they bet on the stock not doing well, and then what happens is that actually not even companies, just users will be all borrowing money against the stock, essentially shorting it, and then at some point something will cause the stock to increase its price, and then all of these shorters get scared, and to close a short position that you don't own the stock of, you actually have to buy more of the stock, and it'll cause this sort of crazy quick commotion scramble of like people who shorted the stock trying to get out of their position by buying shares, and it's just this like slippery slope that causes this huge quick steep increase in price. And you typically see it in what we call like penny stocks under $10. It'll typically be these rides from like $2 to $10, $10 to $20, $1 to $4. You'll see these crazy steep prices. And then what you can do is you get better at it. You can actually, instead of where I buy lower and, ride the momentum up, you can short the stock and ride the momentum down. So that's what I want to change in my strategy. I haven't done anything like that yet, but I need to understand better of how to. I'm good at looking at the news that's causing the momentum swings with my studies to know sort of when the momentum's changing on the downside to the upside. I'm not quite so good at predicting when the momentum is changing from the upside to the downside. But I hope to change that here shortly. So what's the next question? Oh, scanner and studies tutorial. Yeah, I mean, this is really all it is. I use this scanner that I've showed you before in the bottom left. That's where I get my ideas from. I go research them, and I look to see what caused the price drop. If it's an earnings beat, like if it's the story I just told you, where the stock released earnings the night before, it caused the price to shoot up, and now sellers are taking their profits and pushing the price back down. That is like my ideal trade. I love those. I have not lost on one of those yet, and in fact, those have been my biggest wins. You can also see similar things, like sometimes a stock will miss earnings barely, and it'll cause a big price drop. So instead of owners of the stock being like, well, let's just take our profits and bail, they sort of go, I'm not feeling as good about stock ABC as I once was. Let's just close our position. We made a little bit. Let's just close our position and move on. And you'll see a big price drop that way. Either of those two things, either they beat earnings or they just barely missed earnings. I typically like those trades better than the stocks that like really disappoint. Sometimes stocks will have these huge price drops off of like big disappointments. Medical companies, COVID test results came back and they weren't as expected. Those kind of things I try to avoid. I try to look for things that are easy to explain, easy for me to understand, and give me a lot of confidence in entering the trade. The indicators I use are the standard deviation lines. You go into Thinkorswim, you go to studies, and you edit your studies, and these are here. These are the indicators and the metrics that I use. They're nothing special. A lot of people use them. Standard deviation channels, simple moving average, VWAP, MACD, RSI. Just take your time to research and Google what those are, and you'll find tons of educational resources online to show you how to effectively use these studies. And finally, the last question is what? Should you day trade? What should you do with less money just starting? So, my strategy that I'm doing, you can use it with less money, but you have to sort of adjust what you're doing. So let's go back and look at XPO. It's a great example. You could absolutely trade XPO, day trade it the way I did with less money. Let's think about this. So like I have an account with $25,000 in it, which means that TD Ameritrade has put me on margin, which means when you buy a stock and then you sell it, that cash doesn't instantly go to your account. It takes time to settle. It's called settling time. It's like if you go buy something from a store with a credit card and then you return it, you don't instantly get that money back. You have to wait for the cash to like the transactions to process and for the cash to settle back in your account. Same with trading. So if you're trading on a cash account, I've showed this one of my videos, you have settlement time. So if you trade $1,000 that day, you buy $1,000 worth of stock, then that $1,000 won't be available for you to trade with for another couple days. I'm on a margin account, so I'm borrowing money constantly from TD Ameritrade to trade. So I can do pretty much infinite number of trades. I mean, there's a limit to how much I can spend. It's like over $100,000 or something, but not a lot of people do have it, but not everyone has a margin account and qualifies for like the pattern day trade rules. But let's just say, for example, you have $1,000 you're starting with. What I would do is do more so what everybody calls swing trading. So XPO, same thing, right? So what I would do if I were you if I was starting off with $1,000, $2,000, $3,000, $4,000, is I would go look at the same scanner that I use, the same exact one. This 5-minute reversal scanner. And when a stock pops up in there, go and research it. Same way that I do it. But in your mind, just know that you're gonna need to hold on to that stock for longer than a day. So think of it more of a long-term investment. So you want to deal with companies with higher stock prices, because if a company has a higher stock price, their price fluctuates over a longer period of time. So like if a $150 stock drops by $10 and goes up by $10, that's common because it's a $150 stock. If the stock is $20, you don't see those kind of crazy price drops. And typically stocks with higher prices are typically performing better. Companies that are performing better. So same thing, stock pops up on the ticker, go and look into it, and if you see the same story happening, buy as many as you can of this stock. That's one good thing about Robinhood and Webull, is they allow you to buy fractional shares. So maybe you can only afford one share of, well, maybe you could, if you had $1,000, you could afford 10 shares of XPO Logistics. But instead of selling it like here in the same day like I did, you hold it off until tomorrow, and look at that, it went up to $120. So that's a $5 increase. So if you had 10 shares of XPO Logistics and you increased by $5 over a day, it's $50. I mean, that's, if you compare what you're making to your account value, it's the same as what I'm making. It's just that my account value is higher. You can't really rush it. I would suggest, if you have a lower amount of money, just to lower your expectations. The stock market really is a game that is easier to play when you have more money, and much more difficult to play when you don't have as much money. You can't really day trade until you have a substantial amount of money, like $5, $10, $15, $20,000. If you have less than that, do swing trading. Look for these big price fluctuations. Look for good stocks. Like, take the time to look up XPO Logistics. How are they performing? What is their news sentiment? What are firms giving it a rating? Are they giving it a buy rating? Are they giving it a sell rating? And look for these opportunities, for these big drop-offs that are justified, but not for a reason that has anything to do with the long-term valuation of the company. Buy in there and hold it for 1, 2, 3, 4, how many days you want. And the more you study stocks, the more you understand sort of the game and how it works and what causes price drops, things to happen, increases in volume, decreases in volume, different strategies. Just don't rush into it. Don't go watch TikTok videos and just go buy shares of whatever stock some dude tells you to buy because it's going to shoot to the moon tomorrow. Really take the time to learn your stuff. That'll be it for this video, guys. Hope you enjoyed it, and see y'all Monday.